Hey everyone, welcome back to Corporate Decoder, the place where we break down the confusing world of finance so you don't have to, and today we are diving into a really interesting filing from Terra Property Trust Incorporated. Now this is their Q3 report for 2025, and let's just say things are getting interesting with their loan portfolio and a bit of a shift in their real estate holdings. Stick around to see what those numbers really mean for investors. Alright, let's get straight into it. Terra Property Trust Incorporated is a real estate investment trust that focuses on commercial real estate credit investments. Think of it like this: they give out loans for big commercial properties and also invest in real estate directly. The report we are looking at covers the period up to the 30th of September 2025, and it gives us a snapshot of their financial health. Let's start by looking at the company's assets and liabilities. On the asset side, cash equivalents and restricted cash went from about $11.5 million at the end of 2024 to over $20 million by September 2025. That is a pretty significant increase in their liquid assets. Now, the big story here is their loan portfolio. Loans held for investment, which is their main business, went from over $233 million to about $178 million. This is a substantial decrease, which means they are either getting paid back on a lot of loans or they are selling them off. On the flip side, their equity interest in unconsolidated investments stayed pretty much the same at around $106 million. This suggests a strategic shift possibly away from direct lending and more towards partnerships or other forms of investment. When we look at liabilities, we see unsecured notes payable increase slightly to over $122 million. However, secured financing agreements took a massive drop from over $205 million down to about $89 million. This massive reduction in secured debt is a huge deal and likely explains some of the cash increase we saw earlier. They have clearly been paying down their secured borrowings. Now let's talk about the bottom line. The company reported a net loss of over $17 million for the first 9 months of 2025. This is a significant number, and it is actually an improvement from the $21.5 million loss in the same period in 2024. So while they are still losing money, they are losing it at a slower pace, which is a positive sign. One of the most important numbers in a loan business is the provision for credit losses. This is the money they set aside for loans they think might not get repaid. For the 9 months ending in September 2025, this provision was almost $6 million. This is up from the $3.7 million provision in 2024, indicating they anticipate more loan defaults or a worsening credit situation, perhaps due to economic pressures. Interestingly, they had a significant loss on the sale of real estate amounting to almost $2.9 million in 2025. This ties into the balance sheet numbers I mentioned earlier, showing a big drop in their real estate owned assets. It seems they are actively selling off properties. Remember how their secured financing dropped dramatically? Well, that is reflected here. Their interest expense on secured financing went from over $20 million in the first 9 months of 2024 down to about $11.7 million in the same period of 2025. This is a direct consequence of paying down that secured debt, and it has a significant positive impact on their overall profitability. Now, a bright spot in their financial performance is income from unconsolidated investments, which surged from about $2.2 million in 2024 to over $5.6 million in 2025. This means their partnerships and joint ventures are performing much better and contributing more significantly to their bottom line. This aligns with their business strategy, potentially focusing more on these types of investments. When they buy real estate, they sometimes have to account for things like above or below market rent intangibles. These are basically adjustments for leases that are better or worse than current market rates. In 2025, they had a negative amortization of over $959,000, meaning this is impacting their revenues negatively. This likely relates to those properties they are selling off. Let's go back to the loans. The company shows its loans held for investment both funded and unfunded. The total carrying value for funded loans held for investment shrunk considerably down to about $178 million from over $233 million. This is a key indicator that their core lending business has reduced in size. The allowance for credit losses on these loans also decreased, which might seem counterintuitive given the increase in provision for credit losses, but this is likely because the total loan portfolio is smaller. An important detail is the classification of non-performing loans. As of September 2025, they had over $152 million in non-performing loans, which represents a significant portion, close to 60% of their total loan portfolio in terms of amortized cost. This is a major risk factor and shows a significant part of their lending operations is in distress. And the allowance for credit losses on these non-performing loans is almost $52 million. This shows they are anticipating a substantial loss on a large chunk of their loan book. They also categorize their performing loans by risk rating from 1 to 5, with 5 being the highest risk. Interestingly, as of September 2025, they have 0 performing loans in the highest risk category. This seems to contradict the high level of non-performing loans, but it might mean that the non-performing loans are in a separate bucket and are not included in this particular risk rating breakdown. Looking at their unsecured debt, these notes payable remain relatively stable at just over $122 million. The big change was in secured financing agreements where they paid down the balance significantly. This deleveraging is a key theme in their financials. The interest expense on secured financing for the 3-month period ending the 30th of September 2025 dropped by a massive $2.7 million compared to the same period in 2024. This is a direct result of paying down that secured debt. For the 3 months ending September 2025, their net loss was about $6.7 million compared to a loss of almost $7.8 million in the prior year. So a slight improvement quarter over quarter there. Their income from equity interest in unconsolidated investments, especially from Resoff, which is an affiliated limited partnership, saw a nice increase to over $2.7 million for the quarter, compared to about $1.9 million in 2024. This shows their investments in partnerships are growing and becoming more profitable. The company reported a loss on sale of real estate of over $823,000 for the quarter. This ties into their strategy of selling off properties. Now about the management fees, Terra Property Trust Incorporated pays significant fees to its manager, Terra REIT Advisors Incorporated. These fees include origination and extension fees, asset management fees, and disposition fees. For the quarter ending September 2025, these fees totaled over $3.3 million. While these are normal fees for a REIT, it is worth noting that they are a substantial cost of doing business. Looking at the bigger picture, Terra Property Trust Incorporated is going through a significant transition. They are dramatically reducing their secured debt and seem to be shifting away from traditional loan origination towards more managed investments and possibly selling off some of their real estate assets. The increase in income from unconsolidated investments is a positive sign suggesting their strategic partnerships are paying off. However, the high level of non-performing loans and the associated provisions for credit losses are a major concern and highlight the ongoing risks in their core business. They are also carrying out substantial sales of real estate, which is impacting their revenue and leading to losses on sale, but also reducing their debt load. Their success will hinge on managing the credit quality of their remaining loans and effectively growing their income from equity investments and joint ventures. The large drop in secured debt is a strong move towards financial conservatism, but the health of their loan book is still the main story. What do you think about Terra Property Trust's strategy and these financial results? Let me know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more in-depth analysis of corporate filings. And if you want to join a community discussing these kinds of insights, check out our Discord server linked in the description. Thanks for watching, see you next time.